How big banks make money off your GICs. Have you ever wondered why banks are so eager to sell you GICs or advertise safe savings? It's not just because they care about your safety. It's because GICs are actually very profitable for banks. In this video, I'm breaking down exactly how banks make money off your GICs, including what a GIC is and how it works, the strategies banks use to profit, how mortgages and bonds play a role, risk management techniques banks use, and even safe alternatives to GICs like principal protected notes and segregated funds. Welcome to the channel. My name is Anthony Gismondi, and I'm a wealth advisor with Aegis Wealth Management, a part of Wellington-Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, make sure to subscribe and click the like button. What is a GIC? A Guaranteed Investment Certificate, or GIC, is one of the safest investments in Canada. You deposit your money with a bank for a fixed term. It could be as short as a day or as long as several years. You then earn interest at a fixed or variable rate, and your principal is guaranteed. You can't lose your original deposit. GICs are even insured by the Canadian Deposit Insurance Corporation, or CDIC, for up to $100,000 per institution, giving investors some added peace of mind. The longer the term, the higher the rate you'll typically get. For example, a 2-year GIC might pay 3% annually, while a 3-year GIC could pay 4%. But even though GICs feel safe for you, they're not charity for the bank. How banks make money. Banks have several ways to profit from GIC deposits. Let's go through the main ones. Number 1, interest rate spread. Let's say you buy a GIC at 3%. The bank takes your deposit and lends it out as a mortgage at 6%. That difference of 3% is their profit margin. Banks also use those funds to issue personal loans, business loans, and lines of credit, all at rates much higher than what they're paying you. Investing in bonds and fixed income. Banks don't just lend your money, they also invest it. Government bonds for safe returns, corporate bonds for higher yields, mortgage-backed securities. Here's how it works. A bank could take a 2-year GIC deposit and then invest it in a 5-year bond yielding 5%. They manage liquidity so they can still pay you back at maturity while they're pocketing the higher return. Risk management, or asset liability management. Banks constantly balance the money they borrow from you through deposits and GICs with the money they lend or invest. Duration matching. They make sure that loan terms and GIC matures align. Cash flow immunization. They ensure that inflows and outflows are timed. Stress testing. They model how interest rate changes affect profits. These all allow them to stay profitable even if rates shift dramatically. Hedging with derivatives. Beyond balancing loans and deposits, banks use tools like interest rate swaps to lock in profit margins, forward rate agreements to fix future borrowing costs, options and futures to protect against rate volatility. These strategies ensure banks can meet GIC obligations while still making money. The benefits of GICs to banks. GICs are incredibly attractive for banks because they're stable funding, your money is locked in till maturity, they're cheaper than borrowing elsewhere, they're CDIC insured, which gives you confidence and allows banks to pay lower rates safely. They create cross-selling opportunities. Once you're a GIC client, banks can sell you mortgages, credit cards, or mutual funds. Alternatives for conservative investors. Now, if you're someone who likes the safety of GICs, but wants potentially better returns without taking stock market risk, there are a couple of alternatives worth knowing. Number 1, principal protected notes, or PPNs, and market-linked GICs. These are structured products that guarantee you'll get your principal back in maturity. Part of your money buys a zero-coupon bond for the guarantee. Another part buys an option tied to a market index. If markets perform well, you'll share in the upside. If not, you still get your money back. Downsides, fees are embedded, reducing returns. They're illiquid, you usually must hold them to maturity. Tax treatment, any returns are taxed as interest income, just like GICs, not as capital gains. Segregated funds. These are investment funds wrapped in a life insurance contract. They offer maturity guarantees, often between 75 and 100%, and death benefit guarantees. They can bypass probate and sometimes offer creditor protection. However, the MERs, or management expense ratios, for these products are significantly higher than regular mutual funds, which can drag down long-term returns. Guarantees often only apply if you hold them for 10 to 15 years. Taxation of GICs and principal protected notes. It's important to remember interest income from GICs is 100% taxable at your marginal rate. The same goes for principal protected notes. Even if they're tied to the stock market, their returns are treated as interest. If you hold these in a registered account, like an RSP, a RIF, or a TFSA, you can avoid this immediate tax hit. But in non-registered accounts or corporate accounts, the tax can significantly reduce your net return. Why independent advice matters. Banks are in the business of making money off deposits, loans, and investment products like GICs. It's not inherently bad. It's just how banking works. But it's important to know what's in your best interest, not just the bank's. An independent advisor, someone who isn't tied to one bank or one product line, can help you. Understand these products and fees, choose investments based on your financial goals and tax situation, explore equally safe alternatives without unnecessary costs. You can build a plan that's about your needs, not just the bank's compensation structure. GICs are safe, reliable, and have a place in many portfolios, but now you know exactly how banks make money from them and what other conservative options you have. If you found this helpful, give it a like, subscribe, and share it with someone who's sitting on too many low-interest GICs. And remember, talk to an independent advisor before locking up your money. It could save you thousands and open up better opportunities for your future.